All right, let's talk about something that seems totally backward. Have you ever seen this? A company's profit takes a nosedive, but its stock price just shoots up? It sounds crazy, right? Well, that's exactly what happened with the Indian IT giant Infosys. Their latest results looked, kind of messy on the surface, but the market loved it. So, how in the world does a profit drop lead to a stock surge? We're going to unravel this whole paradox. So, what was really going on here? What did the smart investors see that the rest of us might have missed in those scary looking headlines? Okay, just look at these numbers. They paint a really confusing picture. On one hand, you've got the share price jumping up by nearly 5% right after they announced their results. But then, on the other hand, the company's net profit, it actually fell by a pretty staggering 9.6% from the last quarter. I mean, that just doesn't seem to make any sense, does it? Well, like always, the real story is buried in the detail. So our investigation here is going to start with the revenue. To really get why the market was so optimistic, we've got to look past that big, flashy profit number and just follow the money. And right away, here's the first big positive sign. Yeah, the quarterly profit was down, but check this out. Their revenue was actually up by almost 9% compared to the same time last year. Now that's a really healthy number. It suggests that even with a global slowdown in IT spending, the company's core business was surprisingly solid. But wait, there's another layer to this, especially for a huge global company like Infosys that's earning money in dollars, euros, all sorts of currencies. We have to talk about something called constant currency growth. Now, what's that? It's basically a way of looking at their revenue that totally ignores the wild swings in currency exchange rates. Think of it like this. It clears out all the noise so you can see the real underlying demand for what they're selling. And here's the key. Even when you look at it through that constant currency lens, Infosys still showed positive growth. And they told investors something absolutely crucial. This revenue bump wasn't just some lucky break from a good exchange rate. No, this was coming from actual, solid business performance. Okay, so if the revenue was stable and the demand was real, that brings us right back to our big mystery, doesn't it? What on earth caused that nearly 10% drop in profit? What was dragging the numbers down so hard? Well, here's our culprit. It turns out Infosys recorded a massive one-time charge of 1,289 crore rupees this quarter. Just poof. This single accounting entry was the main reason the profit numbers looked so bad at first glance. So you're probably wondering, where did this huge charge even come from? Let's break it down real simple. Step 1, India introduced some new labor laws. Step 2, these new laws basically increased the future cost of employee benefits. And step 3, the accounting rules forced Infosys to account for the entire estimated future impact of this change all at once, right here in this one quarter. And this is the really crucial point. Investors looked at that and immediately understood this isn't a business failure. This is an accounting thing, a regulatory change. It was a one-time hit. It wasn't going to happen again next quarter or the quarter after that. So they saw right past this temporary dip. And you know what? Once they looked past that big one-time charge, what they saw underneath was actually incredibly positive. So let's take a look at the hidden strengths that really drove that stock price up. First up, the deal pipeline. This was a huge factor. Get this. Infosys signed a whopping $4.8 billion worth of large deals in this quarter alone. That is a massive signal for future revenue, and it just screams that big clients have a ton of confidence in the company. And it gets better. Over half of that huge deal value, we're talking 57%, was net new. Now, what does that mean? It means it came from brand new clients or totally fresh projects, not just old customers renewing their contracts. Net new business is the lifeblood of growth, and a number like that, that's really, really strong. And to top it all off, the company also brought 121 new clients on board this quarter. I mean, it just keeps adding up. It signals a healthy, expanding business that's out there winning new customers and building a really solid foundation for the future. Another big sign of strength, diversification. While the North American market was, a little weak, Europe was absolutely on fire, growing by over 13%. That powerful performance in Europe more than made up for the softness anywhere else, and it proved the company isn't just relying on one single region to succeed. So see, when you start to put all these pieces of the puzzle together, the fact that the profit dip was a one-time thing and the incredible strength you see in the underlying business, you get a completely different picture than the one you saw in those scary headlines. And all of this brings us to the most important idea in this entire explainer. The market wasn't just looking at the headline profit number. Nope. It was looking at something much, much more important. It's called the quality of earnings. So what in the world is quality of earnings? Well, in this case, it was high for a few simple reasons. The core revenue was stable and growing. That big hit to the profit, it was a non-repeating one-off event. The future deal pipeline was absolutely robust, and the underlying demand for their services was healthy. That is what investors truly care about. So, really, this whole Infosys situation is a perfect lesson in looking beyond the obvious. It teaches us that the headline number, it rarely ever tells the whole story. So, the next time you see a shocking financial headline, maybe you'll remember to ask yourself, what's the quality of the story that's really happening underneath?